Okay, I think we're live. Welcome, everyone. This is the Anderson Report, back with a Sunday night show. And there are plenty of things that we could talk about. It's been a little while since we've done a broadcast, but clearly the topic that everybody's talking about and that everybody wants some insight or input into or to comment on or to hear people talk about is the GameStop Reddit RobinHood, if you will, trading / investing phenomena that has been pretty much the talk 24/7 since pretty much all week, but really it started very strongly. Yes, thank you. We're back after a little bit of a hiatus for a few different reasons, which we won't really go into right now, but we maybe talk about it a little bit in a later broadcast this upcoming week. I thought that 7 o'clock tonight was a good time to go live. We're not competing with football. We're not competing with the Super Bowl. We're not competing with NCAA or NFL playoffs. And there's plenty to talk about. So, if anyone has any questions, I'd like this to be as much of an interactive show as possible. I think that tons of attention will be followed to this GameStop, Reddit, RobinHood phenomena. I don't think it's going to go just simply fade away this next week. I think we'll still continue to have volatility in the market as a byproduct of it. And I think that we will have plenty to talk about in upcoming shows this coming week. Irene, thank you so much for joining us tonight. So, obviously, GameStop is a stock that used to be an online retail type destination place with I don't know how many thousands and thousands of outlets, although I had read over the weekend that they had closed 1,000 of them since mid 2019. It's a place where you could take old, outdated electronic stuff, video players, handheld cassette players, CD players, old phones, etc., sell them, buy new ones, buy used stuff. When the whole gaming stuff started to be a really big thing 10, 12 years ago, it was a very popular place. Clearly, they lost the transition. They missed the big transition to internet dominated games and gaming activity. Their franchise went sharply down in revenues and traffic, and it's been a suffering enterprise since then. Now, I'm going to mention two things real quick. First of all, thank you everyone for joining us. This is my YouTube channel. I am Tim the Source Anderson. The channel is The Anderson Report. It's also streaming to Periscope on TJ Anderson 12. At the end of March, Periscope is going away. It's going to transition to strictly Twitter Live. I'm not sure what handle we'll be at then, but we've got a couple months to figure that out, and there'll be plenty of updates before then. So I currently do work for a broker-dealer in New York, and I have to be a little bit careful talking about individual stocks. Nothing I say should be interpreted as a buy or sell recommendation or a investment advice that you should be buying or selling certain stocks. And that plays into this whole GameStop phenomena later in terms of the chat rooms that were driving a lot of interest, not just in GameStop, but in a lot of other names. So let's talk about really how this started. I think both with GameStop, which is certainly the center focus of attention for this whole phenomena, and also for AMC, which is AMC Movie Theaters, which was also, like GameStop, a business that was in a decline due to the massive onset of people streaming videos at home rather than physically going to a movie theater. And then the outbreak of the COVID virus that shut down public commerce pretty much everywhere in March and April, May. Some states started to open much more quickly than others, but most theaters are still really just operating on a shoestring with a small percentage of revenue that they had going into this, and even that was a significant decline. Even pre-COVID, the movie theater industry was suffering. So both of these stocks, GameStop was a suffering, lagging business that had been declining for years, even pre-COVID. AMC Movie Theaters, a suffering industry in a decline for a number of years, even pre-COVID. Clearly, both of these stocks were, the GameStop was a $4 to $5 stock for a couple of years. AMC Theaters was a very low price, single digit stock. They both had big issues, but both of them had a catalyst that helped set the stage for this massive move in their stock price, which was also fueled by the fact that a tremendous amount of people were short both names. GameStop maybe a little bit more than AMC. Yes, Irene, I'm going to get to that question in just a minute. John, it's great to have you with us. Yes, I have been on a little bit of a hiatus, but now I'm back. And it couldn't be more timely because there's a lot to talk about. So, both with GameStop, it was very heavily reported that 140% of the outstanding shares were short and had been shorted by hedge funds, aka the evil hedge funds, at least according to the Reddit chat rooms. And of course, the main chat room in Reddit that was fueling most of this was the now infamous chat room titled Wall Street Bets. Wall Street Bets. There are a couple others of them. Maybe we'll get a troll or two in here from one of those websites that are looking to interrupt our conversation tonight. We'll have to see. Now, whether or not really 140% of the outstanding shares were short in GameStop, I think is still a little bit in question. We'll get into that in a little bit. The short interest in AMC was also very high, but it was nowhere near what it was in GameStop. Now, both companies had when I say both companies had an event that helped spark this huge move in their share price. Okay. GameStop had a investor. The guy's name escapes me right this second. That's why I'm kind of glancing down at an article that I had seen in the Weekend Barons, and of course, I'm not really going to be able to find it right now. But an individual who had been very successful in online commerce, who had been running Chewy's, which I believe is a online pet food retailer, which was very successful in building its business, even with the onslaught of Amazon trying to get into that market. Uh, he was very successful, and he had, I guess, bought a fairly significant amount of stock in GameStop, maybe as long as a year ago. And probably not necessarily has a history as being an activist investor, but clearly had some conversations with the company. I believe they hired him as the new CEO. Two of his other associates from Chewy's they put on the board. And when that happened, the stock had a very, very short move from, let's say, 12-ish to, up to about $30. And a number of people then, including Barron's Magazine, and including very famously Andrew Leff from Citron Research, who is a well-known, has a well-known research operation that used to, until very recently, as in a few days ago, public short ideas of stocks that he felt were overvalued and or had systemic problems and or had accounting issues and were trading much higher in valuation than they should. Okay, so the GameStop went up to about $30 on the news that this individual was, I got to find his name just because it's bugging me. Just because they had, a new CEO and someone who had significant experience in online commerce and maintain that franchise of pet food sales, even when Amazon tried to make a very strong entree into that market. Ryan Cohen was the co-founder of Chewy's. Chewy co-founder Ryan Cohen. He disclosed a stake in 2000. There's another individual named Michael Burry, who I believe Yahoo Finance had on this last week at one point in time. One of my contacts at Yahoo Finance is telling me that they had Michael Burry on this week. Michael Burry had acquired a fairly sizable stake in 2019. That's when the stock was trading around $4, $5, $6 a share, depending on exactly what month you're talking about. It had been down from $25 in 4 or 5 years earlier. And the interesting thing about Michael Burry is that he was famous for calling the bubble in the mortgage market, and particularly the mortgage securitization market back going into the financial crisis. He probably made that call very early 2008, maybe even late 2007. So he's a guy that the financial media and a lot of other investors are potentially going to look to as someone that has a history of making timely opines or calls in things that may be or may not be a bubble, and or extremely overvalued or extremely undervalued situations. So GameStop gets a new CEO, a guy that has a lot of experience in the online business. He says that they're going to close a lot of stores and change this business online. The stock has a big jump. It catches the attention of a lot of people in this Wall Street Bets chat room and Reddit, which already had about 1.5 million, maybe 1.8 million participants or people who had signed up for the chat, not necessarily in it every day. And it's a company, bear with me, And it's a company that probably a lot of people, gamers, I don't want to just say millennials, but people in their 20s, maybe even early 30s, maybe even mid 30s. GameStop's a company that a lot of them had with them. It had a familiar brand name. They probably had gone there as teenagers, or even people, even or very early teenagers, late teenagers, maybe even in their early 20s, when GameStop was a place that you could take your old Nintendo products that you weren't using anymore because you just traded up to newer stuff, and you could go to GameStop, you could buy used stuff, you could sell your stuff there. And it was a great place. I remember even a dozen years ago or longer, taking my daughter to the local GameStop on numerous occasions for buying early generation online games, toys, devices, that were, part of the first generation electronic gaming craze. Okay, so AMC, one of the other stocks, one of the main stocks that was being talked about, the stock was very low single digit stock. I don't know exactly what was trading, $1, and a half, $2, $2.25, something like that. Dead in the water for a long time. They had a catalyst that also helped the stock catch a lot of people's attention, AMC movie theaters, and that was they were on the brink pretty much. They needed some financing, and they arranged a very, very significant piece of financing about a week and a half to 2 weeks ago. Okay. And what that did was that halted what would have potentially been an inevitable bankruptcy from the company. The stock got a little bit of a lift on the news that they had this financing, and then a couple of other things happen, and boom, away we go with AMC. It's a low price stock, very easy to buy, more than just one share of it for a lot of people. And the stock had a move from what was probably a little bit below 2, a little bit above 2, had a move up to $8 last Wednesday. Even high, you know what? I take it back. I think it traded well into the teens. It might have traded as high as $18, because one of the other events that took place during the week that started to potentially pop some of the bubble is that Silver Lake Partners, which is a big venture capital firm, had a very large outstanding convertible bond privately placed with them from AMC, very possibly years and years and years ago. And what they did was they exercised that convertible bond into stock. And then it was announced Friday after the close that Silver Lake Partners had sold all 44 million shares worth of their stock from that convertible exercise in the open market on Wednesday at prices above $16 a share. Okay. So here's a stock, AMC, that had been a very low single digit stock, went up to close to $20 a share on Wednesday. But now one of their big investors it came out after the close, had sold all their stock on Wednesday into that big spike. It'll be very interesting to see how AMC acts on Monday when we open up for trading, tomorrow, and throughout the week. Now, Irene is asking a question that is very interesting, because the whole 90% of the media coverage on this has been This is the little guy versus traditional Wall Street, et cetera, et cetera, et cetera. And it's like almost has a few similarities of the big populist movement that we've seen politically on a couple of topics. And this is the little guy against the Goliath hedge fund, David versus Goliath, et cetera, et cetera. How refreshing is it? How great is it to see the little guy win some of this stuff? And Irene's question is really alluding to the fact that, look, this started maybe out this way, but it's not just all the little guy buying the GameStop stock on the way up. And in fact, Barron's over the weekend noted that there have been some 10,000 share trades. There was even one 50,000 share trade at around the $330 level. Now, they didn't say if that was one fund buying or one fund selling, but I certainly don't doubt, especially on Wednesday or Thursday, when GameStop traded down from 350 to below 150, I don't doubt that some hedge funds or even maybe some very aggressive portfolio managers at small cap funds went in and bought the stock very aggressively. And lo and behold, the stock got back up above $300 by the end of the day. Okay. So certainly there are a lot of small individual investors that played the stock. I would hope that a lot of them, if they got in at good prices, being below $100 or even below $150, I would hope that they got out. And I would hope that people that have bought the stock and maybe still own the stock realize that this is, if you're in this stock for a long-term play, it's exceptionally risky just because of where the stock has been, and nothing terribly fundamentally has changed yet. Now, of course, a lot of people are saying, well, look, these people in this chat room and Reddit are showing that there's many different ways to put valuations on stocks. Look, going into the internet bubble in 1999, there were many different ways to put valuations on stocks also. People were valuing new online. This was over 20 years ago. People were valuing new online companies, anything that had a .com at the end of their name, not just on what their revenues or their sales were, but on how many times their website was clicked on that week or that month. It was called the eyeball count. Okay. Well, for most of those companies, that really did not translate into revenue or even sales. And a lot of those stocks that were trading above 200, above 300 went to zero. Okay. I'm not saying that's going to happen with GameStop. I am just saying that, excuse me. I am just saying that I think it's great that there's a lot of new people in the retail space for years, even decades. The big concern on in the market and in the Wall Street community, if you want to say that, and a big concern about the brokerage business overall was that what can we do to get the retail investor to come back? Okay. After the crash in 1987, it took a while to get the retail investor to come back. After the dot-com bubble, and you got to realize, after the dot-com bubble, the NASDAQ composite peaked a little over 5,000 in the March of 2000. 2.5 years later, it was at 1,200. That was a decline of 87%. Okay. That was unheard of. Okay. After that, it took retail investor a long time to come back into the market to feel comfortable with it. Okay. After the global financial crisis, 2007, 2008, it took a long, people said the retail investor is never coming back. They were burnt 10 years ago, being the dot-com bubble. They've just been burned again. People's 401ks have been decimated, et cetera, et cetera. The retail investor is never coming back. Now, retail has changed significantly because a lot of people that decades ago would have invested in retail by buying individual stocks now buy ETFs, which buy individual stocks, or buy mutual funds for diversification. And of course, the mutual funds buy individual stocks. So the nature of investing has changed a lot. But clearly, even before this massive short squeeze that we've seen in a lot of these low-priced, heavily shorted stocks, the retail investor is back. And it's back in spades. Just to give you a couple of numbers. Bear with me. In 2020, 10 million new retail accounts were opened. Okay. The average daily trading volume for retail was about 6.6 million in late 2020. In January, it's already up to about 8.1 million. Now, clearly, last week was a very, very, very high volume week. We're probably not going to maintain those volume numbers, but that's an increase of almost 25%. Even going back close to a year ago now, pre-pandemic, pre-COVID pandemic outbreak in early Q1 2020, retail volume was estimated to be about 15% of average daily trading volume. And now retail volume is thought to be about 20% of average daily trading volume. Options trading, it has increased, it has doubled from 2019 to late 2020. Now, a lot of this has happened because a lot of platforms have instituted commission-free trading. Okay. Now, my concern about that is that it's not really free because all of these platforms, not just RobinHood, but Charles Schwab, TD Ameritrade, Fidelity Brokerage, you can go all the way down the list. They all sell their order flow. And this gets a little technical, but they all sell their order flow to high-frequency trading firms. High-frequency trading firms get these orders to come in electronically. They take the other side of all of them. And they might have those positions literally for seconds. Because if a spread in a stock is 3 pennies wide, 4 pennies wide, 5 pennies wide, they will always, the high-frequency trading firms will always sell on the offering side of the market. They'll buy on the bid side of a market. They may make a half a penny or less. They may make a tenth of a penny or less on the average of all the trades that they do, but they're doing tens of millions of trades literally a week. Now, I think the firm that does it the best is this Interactive Brokers, because Interactive Brokers you can trade for free, or if you don't want your order flow to be sold to a high-frequency trading firm, you can choose that option also, but you will be paying a commission, but a very, very, very small commission. Okay? Because I've had conversations with people who have just started trading, who have said, I don't really understand why I entered an order to buy XYZ and I got my execution. I entered the order at 120. I got my execution at like 123. But in that time frame, it never traded at my price. I'm looking at a chart here or a data feed here. It never traded at my price. Well, that service is probably showing you the primary market, the NASDAQ market, if it's primarily listed on NASDAQ, or the New York Stock Exchange, if it's listed on the New York Stock Exchange. And there are 20 other tertiary exchanges, from BATS to a number of other places, where those orders could be routed to, depending just on, what was going on exactly at that point in time. And that's an order that's being sold to a high frequency trading firm. So even though they tell you you're trading for free, you're not paying a commission on your confirmation sheet, but you're getting an execution that's not a very good execution. And of course, you're never really going to be able to quantify it. But that's why they let you trade for free, because they're selling your order flow to high frequency trading firms that trade in nanoseconds. So and what else, of course, did we have in late 2000, late spring of 2000? We had stimulus checks go out. We had a tremendous amount of people unemployed, working at home, or maybe just staying at home, that were either furloughed or not working. They got stimulus checks in the mail. They get offers in the mail multiple times a week that you can trade for free at XYZ Securities. You can set up an account online in literally minutes. You can electronically transfer your money. And that has you got $600 kickers on unemployment on top of what you would normally get. And you don't have any expenses because you're staying at home. And that, I think, has fueled a lot of this tremendous surge in retail trading. And I think it's great that a lot of young people have a lot of interest in the market. But my big concern is that when this ends, it won't end well. And a lot of people will end up owning a lot of stocks that are trading at 10% of where they were when they bought them. I'm not really worried about the hedge funds. There's a lot of, in these chat rooms, the Wall Street Bets chat room and a number of other chat rooms, the people in there are crazy. I mean, and they're saying a lot of crazy stuff about Gabe, whatever his name is, that's the managing partner at Melvin Capital. That's the place that's down 50% because they were short way too much GameStop. Look, hedge funds go out of business on occasion. Those same people will raise money from other people. They'll start a new hedge fund. There's always hedge funds closing. There's always hedge funds reopening. I'm not worried about those people. I'm worried about the retail investors that are in all these chat rooms that are following advice. And that's what it is. It's investment advice. They might not call it that, by people that have no real experience in the business at all. And all to a lot of these people, for talking to people that I've talked to that have monitored a lot of these chat rooms pretty closely, a lot of these people in this chat room, they don't really care if they make money. Even if they lose money, even if they lose $500 or $600, they're just looking at it as an expense of what they're trying to do. It's money they didn't have initially anyways. And they're just trying to wreak havoc with the establishment of Wall Street and the establishment of a lot of these hedge funds. Well, I got news for you. A lot of these people that run these hedge funds, they're not necessarily 50 and 60-year-old people that have been entrenched in elitist areas of Wall Street for long periods of time. They're people that started out at portfolio managers at big money management firms, have been extremely successful, and have had people tell them, look, if you set up your own hedge fund, we'll invest with you because we've seen what you've done over the last 5 or 6 years. These people might be in their early 30s. Okay. Some of them are older, some of them are younger, but they're not necessarily your stereotypical Wall Street elites. And that's what I see in a lot of these chat rooms. Oh, it's the little guy against the elites. It's the individual investor against the elites. Well, it's the individual. When all this ends and when things go back to normal a little bit, and I'm not saying it's going to happen next week or the week after. I think this is going to still percolate for a while. But the people that I'm much more concerned about are the people who are following the advice of some of the people in the chat rooms who are texting or posting chats. Hey, dudes, buy XYZ stock. Buy it and don't ever sell it. It's going to the moon. Okay. Well, these people don't really have any structured investment experience. Of course, some of them would say, yeah, that's right. They don't have any structured investment experience. That's what's great about it. But people are actually reading that. First-time investors are reading this stuff and acting on it. And if you don't care if you lose $300, $500, $600, $800, $1,200, first of all, you really shouldn't be investing. There's other ways that you could donate your money to causes or something. You're not really going to hurt the hedge fund community or any traditional pocket of Wall Street by doing that. The only people that you're going to hurt is yourself, because what you're buying is going to end up, if you hold it you say, I'm just going to hold this for a year, and you're buying GameStop at $350 a share, it's going to end up being worth 10 times. It's going to end up being worth a tenth of what you paid for it. Look at the cannabis and marijuana stocks from 4 or 5 years ago and where they went to 3 years after that initial craze. I know they've been hot in the last month. They went down 80 to 90%. Okay. So this is, I'm not going to say it's a bubble. The market is not necessarily a bubble, but this little pocket of it certainly looks like a bubble and feels like a bubble right now. The problem with bubbles is you just don't know when they're going to burst and how badly they're going to burst when it's over. Okay. So where else are we going to go from here? Garcia, these people are crazy. Yeah, they kind of are. But, as some people have told me who have spent a lot of time looking at these chat rooms, they don't really care. Some of the people, they don't really care if they lose a little bit of money. They love the fact that they're causing extreme pain at some of these hedge funds right now. But I will tell you, I don't doubt for a second that there are some hedge funds out there that probably have been buying GameStop on the way up and then selling it later in the day or the next day. You know, they if you're playing in this game right now, don't think you're investing. You're trading. And there's nothing wrong with that. But you just have to have some appreciation for how, as fast as these stocks went up, they can go down just as fast. And some of them, like what you've seen with Nokia, coming off $8 and trading back down to $4.50. Nokia was traded above $8 on Wednesday. I think it closed the week at about $4.50. Nokia doesn't even have high short interest. I think Nokia 1% of the outstanding is short. Look, I'm just going on and on and on about the same thing over and over again. There's a huge, tremendous amount of confusion as to what these short interest numbers really reflect, how accurately they're tabulated, and whether the people that are saying there's 140% of the stock short, 100% of the stock outstanding is short, or do they really mean 100% of the float is short? And I don't want to get too technical. I know different people in the chat. I know there's people in the chat that know exactly what I'm talking about. I know there's people in the chat that aren't exposed to the business, and I don't want to get too technical so that I lose people. But the float is the amount of, if there's 200 million shares of stock outstanding in a company, let's call it XYZ, and there's only 150 million shares in the float, that means that 50 million shares is outstanding, but it's held by control people or insiders or investors that were early stage investors in the company that still have a lockup period where they can't sell the stock. Okay? But it's very possible they can borrow the stock. They can loan their stock out. All right? So if there's 150 million shares in the float and 180 million shares is short, that's over 100% of the float, but it's not over 100% of the total amount of stock outstanding. And again, this gets technical. So if there was really more stock short than stock outstanding, that's wrong, and that shouldn't happen. And there are regulations to prevent that from happening. It just means that prime brokerage firms or big brokerage firms that are at the center of this are not doing their job correctly. Because when there are shares that are very, very in very high demand to short, and your person Z, and you call up your broker and you say, I want to short XYZ, he's got to make sure he can borrow the stock. And he's got to go to his stock loan people and the people in his back office and say, hey, can I borrow 10,000 shares of XYZ? And if it's a stock like GameStop, they're supposed to come back and say, you know what, you can't short that. I can't borrow it. It's too tight in the street. I can't borrow it. Because when you short the stock, you have to deliver it. And the only way you can deliver it if you don't own it is that you have to borrow it from somebody who has it. Or you have to borrow it from a firm that has huge retail where they have excess number of shares in their retail pool. I know it gets technical, but and also a lot of the financial media I'm just looking at the chat on occasion. I'm glancing over to the side because the chat is not right in front of me below the camera. A lot of these people in financial media, and I know most of them, and a lot of them are very good, okay? They've been talking about the percentage of stock outstanding as if those numbers are calculated hour to hour. And since trades settle T+2, if you do a trade on Thursday, that trade doesn't settle till Monday. And then after it settles, then the stock has to be delivered. And there are times when delivery doesn't happen for another couple of days. Okay? So I question how accurately this short sale data that people keep referencing in financial media, how accurate is it for that specific day? There's a 2 to 3, maybe a 4-day lag on that data. Okay? It's only reported by the SEC publicly twice a month. And I know that there are ways to get it much more rapidly than that, but I don't think anyone can say today, Wednesday, there were 120 million shares short in GameStop, and yesterday, Tuesday, that's up 10 million from yesterday. Those numbers are not retrievable same day or anything less than a 3 to 4 day lag. Some people might disagree with me. That's my view. Okay. Now, what else did we see? There's 3 different groups of people that are really involved in this story. There's the retail investors. All right. We've talked about them quite a bit. I'm going to call them the new retail investors. The retail investors that are playing this, let's not call it a game, but it's a phenomena. It's a short selling, it's a buying all of these stocks that have very, very high short interest phenomena. Okay. Look, there have certainly been many very highly documented cases of extreme short covering movements in stocks in the past. Google Volkswagen. Okay. Google Volkswagen. I don't have it right in front of me. I'm going to say it was 2011, 2012, 2013, somewhere in that time frame. Might have been a little bit earlier than that. The short squeeze in Volkswagen. It was epic. Okay. Look, Volkswagen's a big company. A lot of stock outstanding. I don't really recall how much of it traded US or not. A lot of very sophisticated funds were short Volkswagen in the local market in Germany or through ADRs. And they got really hurt. Okay. But that's just one example. So you've got the retail Redditors, let's call them. And I do have an issue with the chat rooms. And I used to limit this to 45 to 50 minutes. Would you? Oh, Kathy, thank you for joining us. Would you like to comment on Elon Musk tweets about short selling? Is that actually contained in what you're discussing right now? Well, I don't know if I can tell you. I don't know exactly what tweets you're referring to. But you got to realize one thing. First of all, it's a great question. All right. Tesla was a heavily shorted stock for a long time. Okay. For years, they didn't have earnings. They had some issues with some batteries in their cars blowing up, fires, etc. There weren't charging stations anywhere. Their cars were really only affordable by people that were making a lot of money. Maybe I don't think you could buy one for less than $60,000. This is 4 or 5 years ago. And there were always short sellers that were not necessarily attacking Elon Musk, not claiming that he was pushing the envelope on his accounting practices by any stretch of the imagination. Although I do believe that SpaceX was a public company at one point in time, and that they were having a lot of issues raising money. I can't remember the specifics of it. And I believe that Tesla bought them. And a lot of people said, whoa, what's going on here? How can he do this? Well, he controlled both companies. And look, Elon Musk is a brilliant guy. He's a revolutionary guy. He's been wildly successful. He's done some dopey things in the past. Okay. When he put out that tweet that he was thinking about taking Tesla was trading 375, 380, maybe a little bit lower than that, maybe 350, 360, thinking about taking Tesla private at 420, financing secured. He never really should have tweeted that. Okay. Because his financing was not secured. And I think he got slapped pretty good by the SEC for that. You're talking about the CEO of a company saying a statement in a public forum that was clearly not true. And maybe the 420 was in his mind a little bit of a joke, because 420 is kind of like a code word for marijuana. But so he got his, and Andrew Left, who was the guy who got, yelled at. See, here's where the people in this chat, Andrew Left was saying it at 60 or 90 that GameStop was going back to 20. All you people are going to lose all your money. Da 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 da. He's always been. He runs Citron Research, and a big part of their business for a long time has been publishing short sale recommendations that he feels people should act on, and that he has also traded on for his own account, and he will always add the proper disclosures that he is short the stock, et cetera, et cetera, et cetera. And then there are guidelines as to if you're short or long, you can't go out with a public opinion on a stock within 3 to 5 days, or whatever the time frame is on when you initiate or add to that position. So it's not like you can't really pump your stock. Okay. And my argument has been, and Kathy, I don't want to get off track, but so I don't really know what Elon tweeted. I know at one point in time he tweeted early Friday morning, he put Bitcoin on his Twitter profile. Bitcoin opened $6,000 higher on Friday. Couldn't get through 40,000 again. I think it closed Friday only up 1,000 when it had been up 6,000 earlier in the day. I'm going to bet that's not the tweet that you're referring to. I think Elon was very overjoyed with the fact that the short sellers who he fought with for many years were being hurt badly, even though it wasn't being short Tesla this time. Because I think Elon he spent a number of years, 5 or 6 years, battling the short sellers who were naysayers about his company. And I think he is really enjoying the fact that they are now being hurt, being short companies that probably 98 times out of 100 should be shorted, whereas his company was like a one-off. But you had to look way into the future. I think he made a comment about I'm really loving Etsy. Well, he didn't say he was loving the stock. He said he's really loving Etsy. Etsy went up that day, and apparently he had bought something for his dog on Etsy or something like that. Okay. He may have also said, I think it's great that these people are, making money in the market, participating in the market, et cetera, et cetera. He said, well, you see, he said short selling shouldn't be a thing. You're not going to get that to happen. See, the history of short selling was, and many people probably know this, before the Great Depression, before the big stock market crash in 29, you could short stocks. And if you didn't, what happens is if you don't deliver by a certain date, like let's say you short a stock and then you don't deliver because you don't have it. And obviously 100 years ago or 90 years ago, in the late 1920s, yeah, it was not clearly, we did not, you were talking about physically delivering certificates. Okay. You weren't talking about electronically delivering shares, ownership shares through SIAC, which is an entity that handles security transfers. So in one of the regulations, either Securities Act of 33 or 34, after the stock market crash in 29, and then the Great Depression, was that you could only short stocks on plus ticks. Okay. And that was in existence until like 2007, 2008. And the reason for that is because they did not want people to be able to, let's say a company, big pools of money. They did not want them to be able to say, look, let's gang up on XYZ. It's trading at 120 and we're going to sell it down to 80. Okay. Well, pre the Securities Act of 33, 34, you could do that if you were part of a pool of money that was big enough to just constantly sell the stock until it got down to a price. Okay. If you could short stock without a plus tick. And what I mean by a plus tick is it used to be like if the last sale in a stock is 40, okay, to be able to short stock, if you entered in order to short stock at the market, it would offer at 40.01 in terms of decimals. Stocks used to trade in fractions, but now they trade in decimals. So you could only sell stock if it was going to trade at a higher price than the last sale. And the reason for that regulation was that prevented you from saying, I'm selling stock at 40. I'm a short seller. I'm selling stock at 40. The last sale's 40. The next bid is 39.98. I'm selling stock at 39.98. That would be called a minus tick. The next bid is 39.95. I'm selling stock at 39.95. Okay. I'm selling stock at 39.94. I'm selling stock at 39.90. And you keep selling it all the way down to 39.50, or maybe all the way down to 39. Maybe there's a seller of 1 million shares in the marketplace, and you're going to sell the stock down $1 on minus ticks, just hitting every bid in front of that big seller. And then when he goes to sell his stock, you're going to buy some of it at a much cheaper price. But if you need a plus tick, you go in to offer stock short, it has to trade at a price higher than the last sale. Okay. So if the last sale is 40, you have to offer stock at 40 and a penny. You have to offer stock at 40.01. Okay. Now, if it trades at 40.01, you can still sell stock there as long as it's a plus tick, but you can't sell stock at 40. So if the last sale is 40.01 and there's a 40 bid for 100,000, you can't sell that short because it's a minus tick. That's what the rule was until like 07, 08. Okay. Then they took away the plus tick rule. I never thought they should have. Okay. They got a lot of pressure from derivatives traders and from people doing complex algorithmic trading that the short sales rule is meaningless. We're in a different world now. where a lot of this trading is derivative related, and you should take this rule away. On a very, very, very close vote by the SEC, 3-2, they voted to take that rule away. And I don't think they should have. Okay. Could it possibly come back? I would hope that it would, with some exemptions. Now, I do not believe that short selling should be eliminated. Even the academics will tell you that short selling is a very meaningful and important part of accurately pricing assets, stocks, etc. Well, shucks, I'm not familiar with that stock. Yeah, it's great to be back. I would just say that, so let me get back to the short selling again. I think that what we've seen with the clearly the positions that Melvin Capital, if I've got it right, had in GameStop was an outsized position. They lost 50% of their assets in January. Article that's hit Wall Street Journal online over the weekend. It's run by someone who used to work for Steve Cohen, either at SAC Management or more recently at Point72. A lot of people are complaining that he bailed them out, that Citadel bailed them out. There's some wild conspiracy theories going around about the connections between Citadel and RobinHood. It's all garbage. Okay? Look, the fact that Steve Cohen was one of the initial backers of Melvin Capital. The guy who runs it used to be a portfolio manager for him. He has every right to his choice was to either do nothing and let the thing go under, or to put in another couple $2 billion. And believe me, if he's going to put in another amount of money that has a B attached to it, he's going to be very involved in in what's going on there day to day, and they're probably going to survive this, because you're talking about a place that has backing from both Citadel and Steve Cohen. Citadel's just this massive behemoth, that market making firm, and Steve Cohen's really a directional trader turned into global strategic investor that is legitimately brilliant, more so than most people, and way more so than 98% of the people in the business. And I have no issue at all with him defending his initial investment in Melvin Capital. I think that these Redditors and the people in the chat room have some kind of like sick desire to see Melvin Capital go belly up and bankrupt. And, at least for right now, it's not going to happen. Maybe it could be folded into Point72. Maybe, it's going to have a smaller footprint. Maybe they won't have as many employees as they used to. And they're probably going to have a lot tighter controls on what kind of positions they have, and whether or not they have positions that have risk, outsized risk, if tail events. This is a tail event. It's an event that's way more than 2 or 3 standard deviations out from the norm of possibility. So they call it a tail risk. When the people refer to the tail risk, they talk about the 100-year storm or something like that. But the Redditors, some of the crazy people in the Reddit chat rooms were looking for blood. They're not going to get it from Melvin Capital, other than the guy's lost a lot of money, But that happens in the hedge fund world. So, the only other thing that I would say is that It's already been, what are these kids thinking? No bids will be wanted on GameStop at one. I said, yeah. Well, there was a big outrage on either Wednesday. The second half of the week kind of blended into all one big event for me. Just watching it and so forth. It was fascinating. And I got to end this soon because I'm running out of water. But there was a big outrage during the week. This is the one other topic that I just have to hit. Sorry. A big outrage about RobinHood at one point in time, and it had to be Wednesday, saying that they were going to restrict trading. They weren't going to take any more existing positions in GameStop and 3 or 4 other stocks, the stocks that were having the craziest of the crazy moves. Okay. And then a lot of people were outraged by that. Okay. One of the people that was particularly outraged by that, I saw him on one of the financial news networks. I'm sure he might have potentially been on all of them, and he might have even like live streamed it, was Dave Portnoy, who is the guy at Barstool Sports. And I actually like Dave Portnoy. He's, built a great franchise. He's an outspoken guy. And he's also, it's known that he trades. And he was outraged that RobinHood would prohibit people from trading these crazy stocks. Okay. And a lot of people who were outraged by it kind of surprised me a little bit. Charles Payne, who I have a lot of respect for, he's does a great job on Fox Business. He talks about stocks a lot. He invests a lot. He puts his money where his mouth is. He does have an outside website where that's all gets approved and goes through, gets looked at 18 ways to Sunday for regulatory and compliance reasons. He's not just pumping stocks. He was outraged by it. But you got to realize something. The only thing that RobinHood did was they said that they just basically called a timeout. Okay? Like if anyone that's had kids, if you're having if there's 12 to 15 kids at your house or in your yard, and all of a sudden things are just getting a little too crazy, you might call a timeout for 15 minutes. They called a timeout. Okay. And they said, we can't take any new positions right now in GameStop, in AMC, and 3 or 4 other stocks. Okay. Now, they never restricted people from selling existing positions in those names. If you were long 200 shares of GameStop and you wanted to sell it, you could sell it. Okay. But they were just not taking any orders in those stocks right now. You got to realize. And then they were asked at the end of the day, they were on one of the financial news stations it was CNBC. And they were asked by somebody, and I did not see the interview. But the person that was asking them the questions really should not have been. It wasn't Dave Faber. It wasn't Kramer. They never would have asked this question because it wasn't the right question. But they said, were you having a liquidity issue? And the guy clearly said no. So then he was getting hammered the next morning. Well, if they weren't having a liquidity issue, he was obviously lying, because if they weren't having a liquidity issue, why would they halt trading in those stocks? Well, look, RobinHood is not, and I'm not a fan of RobinHood's business model, okay? I'm not an apologist for them, but they could not be having a liquidity issue. They're not a proprietary trading firm. They're not trading positions for themselves. They're taking agency orders, which means they're taking orders from customers and executing them. They don't have positions on their sheet. They're not long and short stocks. You can't have a liquidity issue if you're long or unless you have a lot of positions. But the question would be, and it gets technical. It's a Series 24 question, really, which is something that's very technical. There's metrics that brokerage firms have to have. They have to have a certain amount of capital, okay, to process that is appropriate to process the business that they're processing. Now you got to realize that the volumes at RobinHood exploded this week, maybe 5 or 10 times what they would normally have been. Okay. And there's something called regulatory net capital. And you've got to have regulatory net capital that's at least, and it's a formula, okay? A low percentage, maybe between 1% and 2%, depending on how the formula comes out, of net capital that equals the market value of all the trades going through your pipes, all the trades going through your system, okay? So the volumes in these stocks were exploding to such a degree. I don't know this. I'm just imagining that they probably, you don't know if their systems were overtaxed. You don't know if their internal reporting mechanisms were short-circuiting a little bit. You don't know if they were uncomfortable that they were really being up to date in real time as to their whole order flow network. And if that were to break down, then that would be a big issue. You know, back when the volume exploded on Wall Street after May Day or negotiated commissions in 1975, after May of 75, when you could negotiate commissions on Wall, I'm going to, almost 50 years ago, 45 years ago, when you could negotiate commissions on Wall Street, volume exploded. There were firms that went down because their back offices failed. Because the volume of business going through their back office, this is when everything was paper. Everything was paper. Firms failed because their back offices couldn't keep up with the explosion in volume. Now, it's very possible that RobinHood's a relatively new firm. This is not Charles Schwab. It's been in existence for 40 years. It's not Fidelity Online Brokerage. It's not, TD Ameritrade. Okay. It doesn't have the sophistication of Thinkorswim. Okay. This is RobinHood. It's just a few years. And they've had issues before with the SEC. Okay. I wouldn't doubt, and I don't know any of this, but I wouldn't doubt that they thought they might have a net capital problem. Maybe their internal reporting systems weren't keeping them up accurately. Maybe they could just tell that their computers were like jammed a little bit. I wouldn't doubt that they were on the phone with the SEC saying, look, we might have an issue here. This is what's going on. It's too fast. There's just too much stuff going through our pipes. So I think they're probably, they said, look, halt the trading, slow down your trading in these stocks that have ridiculous. And Wednesday was probably the pinnacle. Okay. That's when Nokia traded at $9, and that's when AMC traded at its peak. Slow the trading down, halt trading in the craziest stocks for a few hours, and then, get it sorted out. If people have existing positions, they can liquidate those positions, but don't take any new positions right now. Because if they would prevent people from selling stock that they had, then they'd have a liability issue. All they were saying is, we can't take any orders to initiate new positions in GameStop, AMC, a few other stocks. So these people that were slamming RobinHood, you just don't know what was really going on there. And I'm not like a big fan of their business model by any stretch of the imagination. But they did the right thing. They did the right thing. What's the alternative? Let the whole system crash? And if the whole system crashes, then people that have existing positions can't sell them because their computers are down. Then you got a liability issue. What if somebody wanted to sell, RobinHood at what if somebody wanted to sell GameStop at 350 and couldn't sell it? And by the time their systems came back up, it was trading at like 150. See, then they've got big problems. So, a lot of misreporting on that, a lot of misreporting on short interest, a lot of misreporting on, the little guy versus the big guy. Certainly there was a lot of that going on, but I think there were a lot of hedge funds that were playing this on the long side too. Look, hedge funds, if they sense that there's a couple other hedge funds that are, if you're a hedge fund and you're not short GME and you're not short AMC, and you don't have any short positions, and you sense that a lot of hedge funds that do have short positions have a problem, I got to tell you something. You're going to go buy those stocks. You're going to play that. You're going to play that wave. You're not going to say, oh, I'm not going to do this because I don't want to hurt these other hedge funds. That's not the way it works. This is a predatory business to some degree. And if there's an opportunity so I think a lot of this, sure, this was sparked by the Reddit chat rooms and by the retail people that felt emboldened to try to squeeze the short selling. But once it got some momentum, there were hedge funds, and I wouldn't even doubt that there were aggressive money managers at small cap growth funds. Some of those guys trade like hedge funds. Frankly, they might not publicize it, but if they sense an opportunity to buy Nokia at $4 and sell it at $7 or $8 3 days later, they'll jump on. They're competing for performance. So I think it started with the retail, but as the week wore on, there was a lot more than just retail going on. Yes, shucks. I'm going to try to be on a lot more often. I had a lot of stuff going on, a lot of family-related stuff going on in October, November, and then in December and January. The holidays just had me backed up a lot. I had to, reconfigure my room a little bit. I got some new equipment in here. I got a new desk. I had to kind of take everything out of this room and put it back in. So I am going to be on more often, and I will be updating exactly when. We're getting a big snowstorm potentially tonight and tomorrow. Tomorrow I'm gonna try to be on tomorrow at 7:00, but I'll update that tomorrow, mid to late afternoon. Listen, I really appreciate everybody joining the show tonight. I know it's kind of been jumping all over the place. I haven't been on for a while. I could have talked about, last week, the Dow and the S&P were down 3.25%. NASDAQ was down 3.5%. I don't really think that's what people really want to. Frankly, I think there's going to be more volatility, and there's going to be more downside this week. Maybe it reverses the middle of the week. Maybe we come in tomorrow morning, the market's up. I kind of don't think so. I think that a lot of places are still going to take their risk levels down. They're going to take their positions down, and they're just going to say, you know what? Let's just cool off a little bit. Let's just see if this craziness continues. Okay. Let's see how much firepower these chat rooms really have, and if they're going to try to branch out and really juice some other stocks. There's a lot of chatter in, these chat rooms over the weekend. There's a lot of chatter in Twitter. People are talking about different stocks they might take a run at. People are talking about, what the next thing might be. I'm not going to get into any of that right now. I got to be real careful about how I talk about individual stocks. But anyway, I really want to thank everybody for joining. This is the Anderson Report. I think we're going to have a lot more volatility, at least this next week. It's going to continue probably for 2 to 3 weeks. But after next week, it'll start to lessen a little bit. I don't think you're going to see maybe the extreme crazy moves that we saw this last week. But what you gotta pay attention to if you're invested, especially if you're invested on any of these stocks that are kind of on the edge a little bit, the levels. How are we trading in terms of where we traded last week, particularly Wednesday, Thursday, Friday? And you got to realize a lot of selling in the big stocks, a lot of selling in the traditional tech names was the hedge funds and the big funds that had to lighten up their short positions. And they were selling a lot of the traditional tech names just to raise capital, just to raise money. Okay. They don't mind taking losses. The hedge funds lose money. They'll have time. They'll lose money. They'll have bad months. They'll have bad weeks. They'll have bad days. But bottom line, they got to stay in business. So if they have to sell Microsoft and sell Apple Computer and sell Google and sell Facebook and sell the stocks that have been the big winners that they still really, really like, if they have to sell them to raise capital for the next week, couple weeks until the dust settles on all this, they will instantly, because those are very, very, very high price stocks and they can sell millions and millions of shares of any of those names in literally minutes. And then that will allow them to raise capital in case they continue to get hurt in names that they might still be short. But I don't think short positions are anywhere near what they were a week ago. And I'll be very curious to see how the financial media reports these short positions at the beginning of next week. Everyone, enjoy the rest of your Sunday evening. I'm going to try to be on tomorrow, but look for the updates. And if you're in the market, just be aware of what you own and whether or not it's potentially subject to a lot of this crazy volatility. All right? Thank you, everyone. And we'll be talking to you soon.